Welcome to the Stock Market Palantir. Today we are going to talk about PGEN. We're diving into the really dramatic activity surrounding Precision Inc. The stock saw a massive surge, up over 25%, right after its Q3 25 earnings report on November 14th. This wasn't just a minor bump. It was a violent market reaction.
It really was. A fascinating and, I think, a necessary conversation. That kind of move, it grabs everyone's attention. It shows you there's extreme investor passion on both sides of the trade.
And our source material suggests this reaction wasn't just random speculation. It was the clear, culminating validation of a multi-stage fundamental de-risking process, clinical, financial, and commercial. So the core question is this: has PGEN fundamentally completed its transformation into a commercially validated de-risk company? Or is this valuation surge just the first skirmish in a much longer, high-stakes institutional battle over, frankly, uncertain commercial execution? I'm going to argue the former. The de-risking is complete, and the market is finally catching up.
I appreciate the conviction. I do, but I'll be presenting the counter-argument here. While I absolutely celebrate the impressive milestones PGEN has achieved, I believe this current valuation surge is premature. Significant, I would say paramount, execution risk remains, and the volatility we're seeing is precisely because of that intense institutional battle. We just don't have enough data from, one single commercial quarter to declare victory.
I understand that instinct, the need to remain skeptical. But I believe the evidence for a completed fundamental shift is just overwhelming, and it's built systematically on three pillars. The market re-rating is entirely justified because Precision successfully eliminated the three primary risks that just crush early-stage biotechs.
Okay, so let's look closely at that trifecta, because the claim here is that PGEN isn't really a biotech story anymore, but a commercial enterprise story.
Then exactly. First, clinical risk. That was removed definitively back in August 2025. This wasn't some accelerated pathway. Papzimeos received full FDA approval for recurrent respiratory papillomatosis, or RRP. That full approval, it just circumvented the need for costly, time-consuming confirmatory trials, instantly maximizing the value of the asset. Then, second, financial risk was eliminated in September 2025. They secured a massive $125 million non-dilutive debt financing.
The non-dilutive aspect is important there.
It's critical. That financing came from Pharmakon, a specialist healthcare lender who conducts, severe due diligence specifically on projected drug revenues. This was not some distressed loan. It was a sophisticated external stamp of approval that the future cash flows from Papzimeos would be enough to service that debt and carry the company to its projected cash flow break-even. So this instantly removed that looming specter of shareholder dilution that hangs over most of these development stage companies.
Those 2 points, they certainly provide a robust platform. I'll give you that.
But it's the third point, the elimination of commercial risk. That's the most powerful validation. The Q3 2025 report confirmed it. PGEN delivered a revenue beat exceeding 300%. They reported $2.92 million against a consensus estimate that barely broke $600,000. You combine that spectacular beat with strong launch metrics, over 100 million covered lives secured, more than 100 patients already registered in their patient hub. This trifecta, it signals an irrevocable shift from a speculative, cash-burning concept to a commercially self-sustaining enterprise, and the market reacted accordingly on November 14th.
I see why you think that reaction was justified, and I have to start by acknowledging the remarkable clinical foundation. Papzimeos it's truly a breakthrough. It's the first and only approved RRP therapy. It addresses the underlying cause of the disease, and their long-term data shows a staggering 95% reduction in surgeries by year 3. The drug works.
And that efficacy is the ultimate value driver.
It is, but the foundation isn't the entire structure. The valuation surge you're citing is based on extremely thin commercial data, one-quarter sales. When I look at the market structure, I see intense institutional skepticism, and that confirms the execution uncertainty is still the dominant risk. I mean, look at the technical indicators leading up to that report. The short interest as a percentage of float is high. It's at 26.13%. And what's more, the off-exchange short volume ratios leading right into earnings were extremely elevated, sometimes approaching 70%. This confirms that large, sophisticated players are highly skeptical of the company's ability to consistently execute and capture that full total addressable market, which, as we know, is estimated at 27,000 adult patients and a massive $2.7 billion TAM. The debate has completely shifted from can they get approved and funded to can they sell it? And that new level of uncertainty warrants a much higher risk premium than the stock is currently reflecting.
I think we need to be very careful in how we interpret that Q3 report, though, especially with the financials. You mentioned skepticism, but the sophisticated market showed remarkable clarity. Yes, the headline GAAP EPS loss of -$1.06. It looked disastrous at first glance.
It was certainly alarming, especially for any retail investors just reading the summary.
Precisely. But the institutional market correctly filtered out the noise. That huge loss was almost entirely a non-cash, a paper charge, specifically 95 cents per share related to the required fair value adjustment of warrant liabilities. That's an accounting function you have to do during volatility. It's not an operational failure. By backing out that non-cash charge, the actual implied operational loss was a very manageable -11 cents, which was, essentially near consensus. The smart money was able to dismiss the accounting artifact and focus solely on the overwhelmingly bullish 329% revenue beat and the concrete launch metrics. They saw operational success where a superficial glance saw an accounting loss.
I'm sorry, but I just don't buy that the market can entirely shrug off an operational loss. Focusing on that implied loss of 11 cents, well, it still means the company is actively burning capital to run the commercial operation, even if it's less than before. Furthermore, analyst targets, like H.C. Wainwright's $9 target, they aren't built on one good quarter. They're built on projections that require future quarterly execution to match or, more likely, significantly exceed this initial beat. We have to consider the potential for, say, initial stocking. This strong Q3 performance might just reflect physicians ordering an initial supply or, addressing immediate pent-up demand. One impressive quarter, potentially boosted by these initial spikes, does not eliminate the fundamental structural risk of sustainably scaling a specialized biopharma launch. We need to see that momentum sustained over Q4 and into 2026 before we can say commercial risk is gone.
That's an interesting point about sustainability, but I would frame the technical risk, that dark pool short volume you cited, very differently. You suggested the 69% off-exchange short volume was a bearish assault. I contend that in this specific pre-catalyst environment, that volume is primarily the technical footprint of institutional accumulation. It's actually a bullish signal.
Okay, but that requires a pretty significant leap in logic for a lot of people. How can high short volume be read as bullish?
Well, we have to understand the mechanism. We have definitive proof of massive institutional buying in Q3. We know that institutions like Patient Capital Management were adding huge blocks of shares. So when a large fund wants to buy, say, 10 million shares without spiking the price on the public exchange, which would just cost them money, they execute that large order in a dark pool, off exchange. To facilitate that immediate trade, a market maker often uses a short sale. They legally short those 10 million shares directly to the fund first to complete the order. That transaction gets recorded as off-exchange short volume. The market maker then just slowly buys those shares back over time on the public market to cover their short. So the high short volume leading right into the catalyst is really indicative of smart money quietly building massive long positions in anticipation of that November 14th re-rating.
That explanation of the market maker mechanism, it's sound, but it can only account for a fraction of the activity. I maintain that the data reflects an institutional battlefield, not just some unified accumulation. If this high short volume was only market maker facilitation, then why is the short interest, the total open cumulative bearish bets, still sitting so stubbornly above 26%? That 26% is proof that substantial, sophisticated capital is actively betting against PGN's current valuation. These short players are using dark pools precisely to add to their bearish positions discreetly, without creating those volume spikes on public exchanges that would trigger a debilitating short squeeze. The high short volume reflects extreme volatility and, really, a deep division among the largest players about the execution curve.
Let's pivot to the value proposition, which I think provides a critical floor, regardless of all this short activity. The core appeal of PGEN is that Papzimeos is a monopoly asset. If we accept the $2.7 billion total addressable market, based on those 27,000 RRP adult patients, and that number is uncontested, then the inherent value is just enormous.
The TAM calculation isn't the debate. The capture rate is.
But the floor is undeniable. Even when retail analysts apply really conservative assumptions, say a 30% market penetration rate, that translates to a per-share valuation target of over $11. This calculation aligns with and even exceeds the consensus analyst target of $7.67. The scarcity value, combined with the successful clinical and financial de-risking we've talked about, it provides a very strong floor that makes current prices attractive even after this surge. Institutions are buying because the intrinsic value is clear.
I'm just not convinced by that line of reasoning, because the monopoly status is irrelevant if the company fails to penetrate the market efficiently. You just admitted that the $11 plus target relies entirely on the assumption of 30% penetration. That 30% figure is the very definition of the execution risk we're debating. It requires a Herculean effort to secure reimbursement, integrate the drug into the ENT physician community, and maintain inventory. The volatility and high short interest reflect deep, persistent skepticism about whether this management team, which, remember, strategically pivoted from the complicated Intrixon entity in 2020, can successfully execute this commercial transition at the required scale and speed. Clinical success is secured. Commercial velocity is still completely unproven.
Well, sustained success starts with solvency and commitment, and I think it's critical to briefly contextualize the prologue to this whole story, the successful avoidance of the NASDAQ delisting threat in early 2025. Facing that bid price rule deficiency, management proved its mettle. They avoided the cosmetic fix of a reverse split. Instead, they secured a massive insider-led financing of $79 million. That act proved their commitment to fundamental value and organic progress, and it set the stage for the de-risking trifecta later that year. They chose difficult, fundamental fixes over, quick appearance boosters.
I come at it from a different way. That event was a story of overcoming a near-death experience, of ensuring the company's survival. And while that's commendable, it was an obstacle overcome, not a forward-looking catalyst for commercial success. The market has now completely moved past survival. The institutional battle we're seeing today is entirely focused on predicting the slope of the Papzimeos sales curve, the sustained quarterly revenue trajectory, and that prediction is inherently a much, much higher risk proposition than just proving fundamental commitment.
Ultimately, I maintain that PGEN's transformation is fundamental and has been fully validated. The company systematically removed clinical, financial, and commercial risks, and that Q3 revenue beat provided the definitive commercial proof that the institutional market was waiting for. The volatility, the dark pool activity, the short interest, it's merely the technical sounds of sophisticated money adjusting to this new, commercially de-risked reality. The foundation is set for massive long-term growth.
And I conclude that while the foundation is undeniably stronger now, the valuation battle is far from over. The high short interest and the complex nature of the dark pool trading confirm that execution risk, the ability to scale, achieve reimbursement, and maintain momentum after one strong launch, is now the paramount concern. Listeners have to weigh that impressive initial data against the persistence of sophisticated institutional skepticism regarding the sustained commercial success of Papzimeos.
The narrative has irrevocably shifted. The debate now is thought over execution and the slope of that sales curve in the coming quarters. That is where all eyes must focus.
Precisely.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.